Late May 2025, we've seen a dramatic twist in American economy. U.S. President Donald Trump summoned the Fed Chair Jerome Powell to the White House. The headline was explosive. Trump publicly scolded Powell for making a mistake by not lowering interest rates, arguing that keeping rates high put the United States at an economic disadvantage. This public clash between a president and the central bank has captured headlines and raised our eyebrows. Trump's message was blunt and colorful. In mid-May, he took post on social media and declared that the consensus of almost everybody is that the Fed should cut rates sooner rather than later. He even jabbed at Powell by nickname, posting that "Too Late Powell, a man legendary for being too late, will probably blow it again." Despite these threats, Fed officials remained unfazed. After the May meeting, Powell quietly underscored that monetary policy will be driven by data, not by politics. The Federal Reserve later issued a statement emphasizing that it will set the policy to support maximum employment and stable prices, based on careful, objective, and non-political analysis. In other words, Powell and his colleagues are signaling they won't rush rate cuts just to please a president, no matter how loud the tweets are. With Trump's calls echoing in the background, the Fed held its target rate at 0.25% to 0.5% in early May 2025. The same level it has been since late 2024. Then, why Fed hold it steady? The Fed's own statement and officials' comments make their reasoning clear. They note the U.S. economy has continued to expand at a solid pace, with a solid labor market, but inflation is still somewhat elevated. In plain terms, growth is okay and jobs are good, but prices are still too high. Chair Powell reiterated this in April 2025 testimony. With the economy strong overall and unemployment low, but inflation above the 2% goal, the Fed is in no rush to cut rates. He said the decision now is to wait and watch data, especially for any inflationary impact from new tariffs or policies. So what is Trump's rationale for pushing rate cuts? He points out that inflation has cooled from its pandemic highs and argues that U.S. interest rates are higher than in other countries. He says that it is a disadvantage for U.S. economy. In his view, lowering rates would act like jet fuel for the economy, boosting growth, stock markets, and maybe his own political fortunes. Trump's tweets and speeches have made this plain. He complained that interest rates should be falling in U.S. as in Europe, and called the Fed's recent statements a complete mess. In April, he accused Powell of playing politics by not cutting rates faster. At the White House in May, Trump again urged Powell to lower rates, saying doing otherwise was a mistake for the country. Behind the theatrics, President Trump and many businesses and homeowners feels the pinch of higher rates. Mortgage payments, car loans, and business borrowing have become more expensive. A cut would make loans cheaper, which is obviously popular with borrowers. Politically, a strong economy can be crucial in critical tariffs here, so these pressure campaigns on the Fed are also about optics and timing. Let's step back and understand the basics of interest rates and its different impacts on economy. Interest rates are essentially the cost of borrowing money. When the Fed raises rates, the loans like for homes, cars, and businesses are become more expensive, which tends to slow spending and investment. This cooling effect helps dampen inflation. Prices don't run away as fast when demand is curbed. Conversely, when the Fed lowers rates, borrowing is cheaper. Spending usually picks up, and the economy heats up and often inflation rises. On inflation, the cutting rates makes borrowing cheap, which can boost spending. If supply can't keep up, prices may rise faster. In fact, economists warn that cutting too early could rekindle inflation, undoing the hard work of recent years. The impact of interest rates on economy is that the lower interest rates can help growth in the short run. Corporate profits and stock prices often get a bump, like as Trump's jet fuel metaphor. But if inflation spikes later, the Fed might have to crank up rates even higher than before, which could crash markets. In elections, a booming economy helps incumbents at election time. Politicians often pressure central banks for stimulus before elections. That's why Fed's independence is crucial. Historically, the Fed has avoided cutting just to influence vote outcomes. Powell emphasized that Fed policy is set by law for jobs and price stability, not by political wins. Now think that, what if the Fed caved to the pressure and cut rates too soon? Most economists worry this would stoke fresh inflation, undoing years of fight against high prices. Already, many forecasters are watching core price indexes closely. If the Fed cuts while inflation is still above target, we could see everyday costs start rising again, hitting consumers in their wallets. Markets would likely cheer initially, stocks might rally, and interest on treasury bonds could drop. but the long-term pain could be worse. The Fed's credibility as an inflation fighter could take a hit. Analysts note that if the Fed gains a reputation for bowing to politics, inflation expectations could become unanchored, meaning businesses and workers start expecting higher inflation, which can become self-fulfilling. One expert bluntly warns that premature cuts leading to high inflation might severely damage the Fed's credibility. Global investors also pay attention too. A rate cut would likely weaken the dollar, making imports like oil and consumer goods are more expensive, which itself drives inflation up. Emerging markets could feel turmoil as dollars flow out. In short, the Fed risks much by easing before the data firmly improves. That's why Fed officials are exercising caution. Even though pressure to cut comes from President Trump, as one analyst noted, policymakers are more focused on actual risk. New tariffs and trade policies have already added price pressure, forcing the Fed to say it'll wait for clarity before moving. In the current moment of mid-2025, the US finds itself in a Goldilocks-like scenario. Not too hot, not too cold. Inflation has come down from its peak, but it's still above the Fed's 2% goal. Growth is modest but steady, unemployment is low, and consumer spending is holding up. The Fed's own forecasts even foresaw a couple of rate cuts later in 2025, but not for a while. Traders are betting on a rate cut maybe by late summer or fall, but polls of economists suggest that consensus is to hold back until inflation is clearly trending down. Meanwhile, Trump's wing of the story continues to play out. Even after May's meeting, Trump didn't let up. He called for rate cuts and criticized Powell again, though Powell publicly maintained the Fed's independence. Powell noted in mid-June that legal rulings confirmed that he has no plans to vacate the job, and that Fed independence is protected. In other words, at least for now, the Fed is resisting the political pressure. So what does this mean for us? In the short term, holding rates steady means borrowing costs like mortgages and car loans will stay relatively high. That's tough on consumers and can slow home sales and car buying. But it also means the Fed is prioritizing keeping prices stable. In the longer run, if the Fed successfully keeps inflation in check, that preserves purchasing power and economic stability, even if it feels a bit tougher today. In the tug-of-war between Trump's push for lower rates and the Fed's cautious stance, the data appear to be winning, at least for now. Federal Reserve officials have repeatedly stressed that they will set interest rates based on economic conditions, not political demands. As of mid-2025, their message is clear. Inflation is still too high to justify a cut, and policy uncertainty, especially due to from tariffs, means they need more evidence of cooling before easing monetary policy. Whether you agree with Trump or the Fed, it's a high-stakes situation for everyone. The outcome will affect credit cards, mortgages, investments, and even the next election cycle. For now, Powell and his colleagues are holding steady, and only time and data will tell if and when they take the plunge on rate cuts. If you enjoyed this deep dive, please like and subscribe for more clear explanations of news. Let us know in the comments. Do you think the Fed should cut rates soon or hold firm? Thanks for watching.